much for joining us today. It's very much appreciated. I'm delighted to welcome James Peterson, who you will see sitting at the boardroom table in this webinar. And James is going to be taking us through the current macroeconomic backdrop and how Rothschild are positioning their portfolios with a view to balancing the risks rewards of the prevailing market conditions. It's no secret that investment managers globally have had a horrid time since the beginning of 2022, predominantly the impact of rising inflation and then the knock-on rise in interest rates, which have caused nearly every asset class to fall in value. However, trying to take a positive out of a negative, we now have interest rates at what you might call normal levels, and that presents many more opportunities for investors than were previously available in the past 15 years. So I'd say that the medium to long-term outlook is a positive one, even if short-term things continue to look cloudy. So I'm now going to hand you over to James, and if you have any questions, please would you put those into the Q&A box, which hopefully you see on the screen, and then James will address the question when he comes to the end of his presentation. So thank you very much, and I'll hand you over to James.
Fantastic. Thank you very much, Peter. Hopefully all of you can hear me this morning. So first of all, thank you to Peter for the opportunity. So to Peter and his team for the opportunity to speak to you this morning, and also thank you to my colleagues here for helping me prepare this presentation earlier today. Also to Mia, who's just off camera here, helping me with the this morning's broadcast. So you are joining us this morning, or joining me this morning, in New Court, which has been the home to the Rothschild family business since 1809. So until the sun went in about 10 minutes ago, you would have been able to see St Paul's Cathedral in the distance there. You may be able to just see it. But New Court has been home to the Rothschild family, as I said, for over 200 years. Our original founder, Nathan Mayer Rothschild, arrived in the UK in 1798, not actually in London, but in Manchester, where he set up an upholstery fabrics business, which was quickly successful. However, he felt, given his desire to grow within the financial services side of things, that he wanted to be closer to the action. So 11 years after that, he moved down to London and he bought us what was a small site at that point, New Court, very close to the action. So just over my left shoulder here, we've got the Bank of England, the Mansion House and the Royal Exchange, all of which were incredibly important to banking businesses back then. It was all about proximity. These days, of course, it's all about the speed of our internet rather than our geographical proximity. But nonetheless, we love having this sort of spiritual home for the business here in the heart of the City of London. So Nathan Mayer, as I said, arrived in the UK in 1798, arrived then down here in 1809. Fast forward 214 years, and you find ourselves still here, albeit not in the original building, but in a building that was finished for the family in 2011. So we've been in here for the last 12 years. Today, the business remains family owned and family controlled. Alex de Rothschild, who is 43, is our group chair. He took over from his father 5 years ago, choreographed succession. Alex, and I always have to use my fingers to count this off correctly, Alex is the great grandson of Nathan Mayer's brother, James, who set up the business in France. So we still have that close family connection today. And although Alex lives just on the outskirts of Paris, he spends a couple of days a week here working with me and my colleagues within both the wealth management business and the wider group. So over the last couple of 100 years, we've obviously seen a lot of change. But within that time, also a number of recurrent themes, which then I think leads us nicely onto today's topic, which is high inflation, high rates, and then the question, high risk. So I will start sharing my screen with you now because I prepared a brief presentation. I've agreed with Peter that I'll probably talk for about 20-25 minutes. I will set the sort of scene in terms of looking at where we are from an inflationary interest rate, equity market and bond market perspective. I'll then consider how we are looking at that within our own investment world at the moment in Rothschild, and how we're positioning the portfolio to take advantage of both the opportunities presented, but also to be aware of the challenges that are likely to continue to come over the next few years. So just sharing the screen. Hopefully what you see here, the first slide talks about inflation in context. So I'm just going to run through our current thinking on inflation, interest rates, and like I said, equity markets and bond markets before moving on. So what this picture shows you, and admittedly it's not the last 200 years, it's a mere 123 years, but it shows you that we've had very distinct inflationary regimes over the past century. So this high inflation that we're seeing today isn't just an echo of the 1970s, but actually echoes a number of periods of high inflation that we've seen over the last 120 years. Most notably, obviously, around the two world wars, but also periods of strong inflation after the Second World War, driven by scarcity of supply and high demand. So whilst it feels very different to be in an environment where inflation is running at 7, 8, 9, 10% today, actually within the context of recent history, it's not as different as we might imagine. You'll be pleased to hear that, like the rest of the world, we can see that inflation is gradually abating. We've seen it abate faster, come down quicker in other parts of the world, particularly in North America, where we've seen inflation come down quite sharply over the last 6 months. And there are a number of reasons for that. We see demand normalizing, so that pent-up demand that we can see in that top left box surge after the pandemic, that pent-up demand has begun to fall off and has begun to normalize. So we're back at nearer trend levels. So this is the data that you see as the ISM New Orders Index, and 50 is the base position. So you'll see that demand has fallen just below the sort of longer term trend on that. Supply bottlenecks have eased. So if we move to the top right hand box, supply bottlenecks have eased. I think one of the big features of inflation, certainly in the early stage of last year in particular, was because we had seen challenges post-pandemic in global supply chains that were then exacerbated by the Russia-Ukraine situation. They have eased significantly, and again, as you can see, that chart in the top right shows that has fallen back actually below the trend line for the last 20 years or so. Commodity prices, they have been obviously rallying sharply post-pandemic, and particularly energy and agricultural commodity prices last year shot up when we saw the impact of the Russia-Ukraine situation, but again have begun to moderate, albeit we've seen oil and gas prices move up a little bit over the last few weeks, but that's largely driven by OPEC in the case of oil, and then some labour disputes in Australia in the case of gas. And then the bottom right, I guess this is the sort of the big remaining question, is about labour shortage. So during the pandemic, we saw a lot of people come out of the workforce. We saw demand for workers increase, and therefore we had the perfect storm from a labour shortage perspective. Fewer people wanting to work, companies wanting to employ more people than ever. Now that situation has moderated. Clearly, as wage price inflation has come in, that's drawn people back into the market. This is showing US data here. It's not hugely different in the UK. It's drawn people back into the market, but nonetheless, we still face some pressures. So it would be naive of us to assume that labour will return to normal levels, perhaps in the UK in particular, where we've got some challenges around recruiting people from abroad in the short term, but nonetheless, we are seeing improvement. And excitingly, we are also seeing, rapid evolution and adoption of technology, which will allow us in some cases, whether we're talking about robotics or AI, to actually fulfill some of those lower value jobs with technology rather than with people, who can then be kept for higher value higher capability jobs elsewhere. So inflation is gradually abating. We don't think we're going to return to that sort of 2000 to 2020 trend of 1 to 2%. We think we're much more likely to see inflation come down to the 2 to 4% range. So when we're thinking as investors, we've got to think within that context, not the inflationary regime that we've had for the 20 years running up to the pandemic. So that then leads neatly onto interest rates. Clearly, interest rates have been the response, the policy response of the central banks to the higher inflation environment. What you see here is 3 lines. So the red line is the European Central Bank, the ECB. The yellow line is the Bank of England, and the blue line is the US Federal Reserve. Now, as you will note, actually prior to the pandemic, Eurozone interest rates, so ECB rates, were actually running at negative 0.5%. So from that perspective, if you were a Euro saver, you were not only losing money in real terms each year, but you were also losing money in nominal terms. It wasn't quite so bad in the US and the UK, but nonetheless, interest rates in both were cut to near zero during the pandemic. When we then saw inflation begin to increase during the latter part of 2021, central banks continued to sit on their hands, not moving interest rates, and their hands were then really forced by the Russia-Ukraine situation and forced to move very quickly. Some commentators, including our own strategy team here, believing the central banks were somewhat behind the curve when it came to these kind of interest rate moves. And we've seen very sharp moves up in the last 15 months, up to 4% in the ECB, 5.25% in the UK, and then 5.5% in the US. Now, you will no doubt have been reading in the press and listening to the radio, listening to commentators talking about the likely sort of end point for interest rates. The markets, at least, and that's the dotted lines here. So this is what's implied by short-term interest rate futures. Sorry to get too technical on a Friday morning, but that's what the short-term interest rate futures tell us. They tell us that interest rates have peaked in all 3 of these economies. We don't necessarily agree with that. We think there could be a little bit further for interest rates to run, but really it depends upon what pans out over the next couple of months. We've also seen longer dated interest rates move up very sharply, something I will touch on later, which has had an impact on things like mortgage rates and company borrowing rates. So it may be that those higher long-term rates actually have the dampening effect that the central banks require, and they don't need to move further. Where we perhaps differ from the markets is that we don't expect rates to peak and then sharply come off. If you look at these lines here, certainly they suggest that actually interest rates will only be held at these high levels for a matter of months, if not less, and then will begin to come off quite meaningfully over the next year or two. The suggestion here that UK and US rates will fall to around 4% and European rates will fall to around 3%. Whilst we think that interest rates may move there eventually, we're sceptical that central banks will move quite as quickly as that, because they will really want to see the inflationary threat snuffed out, particularly the core sticky inflation, these wage price increases and services costs that we've seen snuffed out and move back down to a more normalized level. That is unlikely to be below 2%, as I said, but perhaps in the sort of 2 to 4% range. So high inflation is abating. Interest rates have increased sharply and may now be reaching a plateau, but are unlikely to fall too quickly unless we move into a very recessionary environment. Where does that then leave equity markets and bond markets, which of course are the primary opportunity sets for us as investors? So first of all, let's think about global equity valuations. So what you see here, so the blue line represents global equities. So I'm not just looking at the UK or the US. I'm looking at global equities, because certainly here at Rothschild, we see global equities as our full opportunity set. And what you will see, again, this is starting in the year 2000s. So you will see, those of you old enough to remember, I just about started at that point my career at the top of the markets in 2000. Will remember the tech bubble leading equity valuations extremely high. We then saw equity market valuations fall sharply for the next 3 years before finding a bottom in 2003 and then growing gradually until obviously we hit the buffers in 2007 and we saw equity markets sell off sharply through the global financial crisis, before then embarking on what has been described by many as a significant long-term bull market, all the way up to the end of 2021, when then we saw Russia-Ukraine market sell off, and today we find ourselves slap bang in the middle of that 10-year trend line. So what that tells you is that global equities today are neither above or below their long-term averages. We're absolutely bang on the 10-year trend, which reassures us actually that equities, whilst not cheap, the majority of them are also not too expensive either. So there's lots of value out there for us to go and find for our investors. If we then think about bonds, and I've used UK data here, so the UK 10-year gilt yield. So when we talk about interest rates, we usually talk about short-term interest rates set by the Bank of England. When we talk about long-term interest rates, we usually use the 10-year government bonds, the US Treasuries or the UK 10-year gilt or the German Bund, as the marker for longer-term interest rates. And what this shows you here, the yellow line shows you the yield of that 10-year gilt since 1964. So looking back over 50 years, actually it starts in 1963, so looking back over 50 years. And what the blue line shows you is nominal GDP growth over that time. There has long been a strong connection between the longer dated gilt yield and nominal GDP growth. But what this shows you, therefore, hopefully reasonably clearly, is that periods where the yellow line is above the line are periods where we're being offered quite good value by UK gilts versus the nominal growth environment. And periods where the yellow line is under the blue line are periods where we're being offered poor value by government bonds versus nominal growth that's out there in the economy. And certainly you can see for the last 15 years or so since the global financial crisis, that yellow line has been solidly underneath the blue line, telling us that gilts have been getting progressively more and more expensive until they touched the bottom of the chart and then reversed sharply. And we began to see that reversal happen as we came out of the pandemic. And clearly today, with 10-year gilt yields now approaching 5%, they are above that nominal GDP trend line, and quite significantly so. And so perhaps offering us value for the first time in 14 or so years. And therefore, we have an additional tool in our toolbox to consider today when constructing portfolios for our clients. So how are we positioning portfolios for our clients? And what are we thinking about trying to achieve in this kind of environment? If you'll give me a brief moment just to explain in a sort of headline terms how we think about investing at Rothschild. So our mantra for the last couple of hundred years has always been about wealth preservation. It's about keeping our clients wealthy rather than creating new fortunes. And that means growing our client portfolios ahead of inflation, achieving real returns ahead of inflation. Therefore, rather than trying to overcomplicate it with complex strategic asset allocations with tactical overweights and underweights and all sorts of other things you might see from others, we decide to keep it simple. We break our portfolios into two parts. We think about return assets. So these are those assets we expect to generate growth and drive long-term positive performance ahead of inflation. And then we think about diversifying assets, assets that we expect to provide us with diversification or protection during trickier parts of the cycle. And clearly we've had some pretty tricky parts to the cycle over the last couple of years with the pandemic and then the Russia-Ukraine situation. Now, return assets typically are equities or equity-like investments. So these are things that are allowing us to participate in the success, the positive growth of the global economy by owning shares in great companies. And then diversifying assets take a number of different forms, allowing us to protect against different kinds of risks. So what I will do now is just move on and show you a sterling, so a GBP, British pound, balanced portfolio that we run for our clients. So we call this a balanced portfolio targeting UK inflation plus 3%. And so we think this for the majority of our clients who are looking to take a medium amount of risk and achieve returns ahead of inflation, but not extravagantly ahead of inflation, the balanced portfolio sits well. And indeed, around 70% of the clients that we advise here in the UK have balanced portfolios with us. The others with slightly lower risk or slightly higher risk portfolios, as you might imagine. Now, those colours you saw on the previous page are reflected on this page in more detail. And what you see on the left are our return assets, and around 66% or 2/3 of the portfolio today is invested in those return assets. The majority in individual companies that we know very well. These are great companies with strong competitive advantages, great management teams that we're able to own at a fair price. And then a number of third-party funds that allow us to extend our geographical reach in particular. So to work with managers who think like us in other parts of the world and allow us to extend our reach and increase our opportunity set, particularly in Asia, but also in North America and in parts of the UK where we work with a special small and mid-cap manager here who allows us to look at idiosyncratic and interesting UK opportunities. Then on the right-hand side, we've got our diversifying assets. We've got here 4 different strategies effectively, making up 1/3 of the portfolio, 34% today. One of the things we take great pride in at Rothschild is not trying to predict the future. And that sounds like a contradiction in terms. Why would we be proud about not having an ability to predict the future? Well, we believe predicting the future is extremely difficult. And if we think back to a number of the big events that have moved markets over the last 20 or 30 years, a number of them were completely unpredictable. If we looked at the collapse of the Russian ruble or the Russian economy in the late 80s that sparked the long-term capital management collapse in 1998, if we look at World Trade Center and that's impact on markets in 2001, and then of course more recently if we look at events like the pandemic, those really came out of left field and were difficult to predict. The other reason we don't try and predict things is because research shows that if you are too confident in your predictions, you anchor your investment decision around those predictions. If then you get your predictions wrong, correspondingly, you get your investment decisions wrong. So with diversifying assets, we're not trying to predict the future, but we are trying to think about the sort of shocks that might come along and knock our equities, knock our return assets off course, even if just for a short period of time. So we think about having portfolio protection, and we think of this like insurance. We think about alternative strategies, and then we think about fixed income in a couple of different ways, but I will come on to that. So how are we positioning the portfolio today in response to what I talked about, a higher inflation environment and a higher interest rate environment, and potentially as a consequence, a higher risk environment? Well, we're doing 4 specific things within the portfolio today in order to prepare or position our portfolios to weather what we see as some of the storms that might be coming, but also to take advantage of some of the opportunities that are also out there. So the first thing that we do is to own companies. So today we own companies which will thrive in higher inflation environments. And they might do that in a number of different ways. So we own 2 companies in the financial sphere. We own MasterCard and American Express, who will be beneficiaries of increased money supply as people spend more in a higher inflationary environment. So the very small clips that MasterCard and American Express take off that spending increase hand in hand with that uplift in spending. So therefore, MasterCard and American Express are in a good position to continue to grow their businesses because a number of their costs are fixed, but their revenues, their top line is floating and floating up with global money supply increasing. So that's theme number 1. Theme number 2 is thinking about companies who have got pricing power. So this means companies who are able to go out and put their prices up in spite of potentially challenging economic conditions. We've all seen the fist fight that UK food producers and supermarkets have entered into over the last 15 to 18 months. So whether it's Tesco, Aldi, Lidl, Morrison's, Asda or other, they're all having to reduce their margins and in some cases sell products for a loss just to stay in the game and to maintain market share. So we wouldn't say that those companies have pricing power today. They don't have a competitive advantage they don't have an economic moat, and therefore they're not able to pass on margins to their customers at a point where their customers are feeling the pinch. So a Tesco or a Sainsbury's would be a good example of a company without pricing power. We're investing in a number of companies with pricing power, specifically so that we're well positioned or well protected when it comes to that higher inflationary environment that I talked about, 2 to 4% potentially being the normal for the next 5 to 10 years. And I've drawn out a couple of examples here. Many of you will recognize the logo on the right, which is John Deere, which is the undisputed leader of agricultural equipment globally, not just in terms of the hardware that they sell their customers, their farmers, but also of the incredible leaps and bounds they've made on the software side, and precision agriculture puts them at such an advantage to their competitors that their customers are prepared to pay higher prices for their equipment and their technology. And then perhaps a couple of examples you might be less familiar with. Moody's and S&P Global are two of the world's, or are the two biggest rating agencies in the world. So they are rating bond issuance, not just by governments, but by companies. Now, when a company issues a bond, it usually needs a rating, at least one rating, usually 2 ratings, and therefore it turns to Moody's and S&P Global to provide those. As it's such a small percentage, such a small fraction of an overall bond issuance cost, its customers therefore are actually quite insensitive to the price of ratings, and Moody's and S&P are able to move their prices up without any resistance in line with inflation each year. In fact, we had a meeting with the Moody's CFO earlier in the year, and he was confident that they could move pricing up by 10% a year for the next 5 years and still retain all their customers. But they're also alive to the fact that they need to have, they've got to think about their reputation, they've got to think about fair value for their customers. So they're not going to push prices up that much, but they are in a position to move them up with inflation. So that's a great example of companies with pricing power. And then the last one to look at here is companies that simply pass through inflation. So Linde is the world's leading provider of industrial gases, so to manufacturers, to hospitals, to all sorts of different uses around the world. Now, its contracts with its customers are explicitly inflation linked. So as inflation surged last year, so did the cost of the industrial gases that Linde were providing to their customers, because it was built into the contract before that higher inflationary period. So they were able to simply pass that through and therefore maintain their margins and maintain their profitability. So they are also well positioned in a higher inflation environment. So that hopefully just gives you a bit of a feel for companies that can protect us or participate in a higher inflation environment. Then moving on to think about how to protect the portfolio against inflation. So we've talked about participating in inflation, and now we're thinking about protecting against inflation, and particularly in an environment where inflation may run at double digits. Now, that's not our base case. Now, that was the case in the 70s for a few years, but even when we looked back at that chart that I showed you at the beginning, double digits inflation was only ever really short-lived and was the exception rather than the rule. However, we do want to protect against that, and we take a number of different approaches to this through our own inflation focus fund within the portfolio, which holds a number of different assets, but particularly inflation-linked bonds. And there up on the screen, I've broken it down for you today. You'll see the majority are actually in US Treasury inflation protected securities, US TIPS, but we've also got a recent position in UK government inflation-linked bonds, because certainly until last year and the Truss Kwarteng budget, UK index-linked gilts looked very, very expensive. And then we've also got some exposure to other economies as well, Canada, Australia, Germany, Sweden. And then we've also got a long-term option on US inflation, which will run until 2031. And if US inflation averages over 4% during that period, which is another 8.25 years to run, will pay out significantly for us as investors. So quite an innovative position we've got in the portfolio to protect us against long-term spikes in inflation. Conscious of time and moving on, we've then also been taking advantage of the higher interest rate environment. So whilst interest rates can provide a risk because money gets more expensive, which has an economic impact, we're also seeing those longer dated bonds that I talked about providing better and better value. So what you see in this chart is the the all maturity UK gilts. So this is all UK gilts issued from the shortest maturity gilts of 1 or 2 months out to the longest gilts of over 70 years. And what this shows you is that during 2022, by the beginning of October last year, these gilts fell by 30%. Until that point, we didn't own any long-dated gilts in the portfolio at all. In fact, our average duration in the portfolio was only 8 months, so less than a year. But now we're beginning to see value. So those 5 green dots that you see on the screen are where we've begun to start buying for our clients, our investors, longer dated government bonds. So in October last year, after the Liz Truss Kwarteng budget, we dipped our toes into the water for the first time, buying some 2035 and 2037 gilts. Then again, earlier this year, we started buying a few more of those when opportunities presented themselves. And then through the late spring and early summer of this year, again, as gilt prices continued to sell off, we actually started buying a 2053 UK gilt issued by the government in the summer of 2021 at a premium of 102p. By the time we started buying it in May of this year, it was below 50p, and its 1.5% coupon was giving us a 3% running yield. Now, we're not planning on holding that necessarily until 2053. If we do, we'll be paid 3% a year of income for doing that, plus the uplift from 50 to 100, its redemption value, but because it gives us good protection, because in an environment where interest rates fall again, the capital value of those long-dated bonds will rise and rise sharply, potentially, recovering some of the ground that they lost in 2022. So theme number 3 is building duration, buying long-dated government bonds in the portfolio. And then theme 4 is to make sure we've got the right protection, the right shock protection in the portfolio. So what you see on the screen here is how our diversifying assets worked in that torrid first quarter of 2020, and then in the challenging first 9 months of 2022. Different diversifiers served different purposes, protecting our portfolios in different ways. So what we're not trying to do is predict what the next economic shock will be. We don't know if it's going to be a pandemic. We don't know if it's going to be geopolitical. We don't know if it's going to be fiscal or otherwise. But we do know that something will come along at some stage, and therefore it makes sense to insure the portfolio. So we've made sure that we've continued to diversify our diversifying assets, so that hopefully if a shock comes along, we will have some protection ready to cushion the fall and the inevitable impact on the great companies and funds that we own within the return asset part of our portfolio. Which then draws me on to our final slide and thinking about what this kind of portfolio mix can offer us from here. And obviously this is a common question at the moment. With interest rates running at 5% and the ability to buy some tax efficient short dated government bonds offering net of tax return of 4.5%, many of our clients are saying to us, why should I take risk when I can make returns of 4 or 5% risk-free within the gilt market? Well, I think there are probably a couple of reasons for that. Certainly for short or short medium term expenditure, we wouldn't discourage our clients from owning gilts. We think that they provide a great tax efficient return in this kind of environment, and indeed bank deposits paying 5 or 6% for lower rate taxpayers also look interesting on a 1 to 3 year time frame. And we would encourage our clients to match any known liabilities that they've got to expenditure coming up over the next year or two with cash or cash-like instruments. However, longer term, if inflation is going to be running at 2, 3, 4, even 5%, and interest rates at some point begin to normalize and fall back down to that 3 or 4% level, then those kind of instruments are not going to even offer us inflation protection, let alone returns above inflation. So it's important when we're thinking about investing for the medium to long term to make sure we've got the right mix of assets beyond government bonds and bank deposits, offering us the opportunity to make higher returns. So then the question from our clients today is, well, what could those higher returns look like for a balanced portfolio? What sort of returns above inflation could or should I expect over the next 5 to 10 years? So when we talk to our portfolio managers and we think about those positions that I showed you earlier in the portfolio line by line, we build up a picture on the left-hand side of companies that will generate somewhere in the region of 8 to 10% a year business returns. That means earnings growth and returns coming to us through dividends and share buybacks. But also when we look at the composition of portfolio companies that we own today, we own very few of the hot stocks, the Nvidias, the Teslas, the Netflixes, the Metas, and so on, which are on fairly full valuations at the moment. And we own a number of companies that we think are undervalued and underappreciated. So to that, perhaps we could also assign a little bit of increase in valuation over the coming years as well. So when we put that business return of 8 to 10% together with a valuation change of 1 to 2%, we can then see on the left-hand side of the portfolio how we might be able to make 10 to 12% forward returns from our return assets. And then we look at the diversifying side and think about those assets. Certainly, for much of the last 15 years, those diversifying assets have been costing us money. We've been paying to protect the portfolio. But with interest rates higher, I've talked about the longer dated bonds that we bought. We also own a number of shorter dated bonds. With interest rates higher, we're now paid to protect our portfolio. We're being paid 2 or 3% by those bonds that I talked about for sitting there waiting for their values to increase, which may be in the short term, maybe in the medium term, we don't know. But when we bring those two things together and we have 2/3 of our portfolio in assets that potentially could produce double-digit returns and 1/3 of our portfolio in assets that are producing cash returns for us, but also importantly, protection during periods of stress, then we can bring that together and we can see quite confidently how the portfolio could make returns of 7 to 8% a year or inflation plus 2, 3, 4% over the coming years. So we do think it remains important to stay invested for the medium to long term. We recognize the short-term attraction of gilts and cash deposits. We think the two aren't mutually exclusive, and we would urge our clients to look at cash and short-dated gilts for their short-term needs and then think about investing for their longer-term needs. So at that point, we are just over 35 minutes into the presentation. I shall wrap up and stop sharing and give you a chance to ask some questions. So I will just move back to the questions screen. So have we... my colleague Mia is just passing me across one of the questions that we've got. If you can just bear with me, Mia is typing it into my screen as we speak. Brilliant. Right, so we've got a question in. My SIP has significant index-linked gilt collective fund, which has fallen 33% since January of 2022. What do you think needs to happen in the world for it to recover, and how likely and when might that be? Why hasn't index-linked part helped so far given the high inflation? So thank you very much for that question. So this is a question about index-linked gilts. And that's probably a question that we receive very regularly from clients, because certainly when we think about index-linked gilts, the name suggests that they are going to give us inflation protection in higher inflation environments. And certainly last year we had inflation running at just over 10% at its peak. Yet, as the questioner mentions, the value of that index-linked fund fell by a third last year. Now, the reason for that is an inflation-linked bond or a UK index-linked gilt is made up of two parts. It's made up of that inflation-linked component, both in the capital value of the bond, but also in the coupon, which is inflation-linked. But it's also made up of the interest rate, the sort of nominal or conventional bond or gilt component. And what we saw last year was such a marked sell-off in gilts as interest rates went up of conventional gilts, that actually the negative impact of the interest rates outweighed the positive impact of the inflation linking or the inflation protection that we had. So what that has meant is that we saw inflation-linked bonds fall sharply. So as you might recall, I mentioned through my presentation that we actually didn't start buying inflation-linked gilts in the UK until after the Kwasi Kwarteng Trust budget of October last year, because they looked expensive. Now, there are a couple of reasons why UK index-linked gilts in particular are more expensive than other markets, primarily because we've got a very large private pension defined benefit or final salary pension scheme sector, and their primary tool for hedging their long-term inflation-linked liabilities of their pensions has been index-linked gilts. So they have been significant buyers of index-linked gilts over the last 20-25 years, pushing them to artificially high valuations. In that big sell-off that we saw last year because of interest rates, those gilts fell an incredibly long way. Some of the longer dated index-linked gilts actually falling over 70%. We now think that they offer value. That's why we own them in the portfolio. We now think that they will give us some inflation protection from here, because they are obviously explicitly linked to UK, well, what is RPI today, but what will become CPIH inflation from 2030. However, the environment within which we think they will offer the best returns is that 1970s stagflation type environment, where inflation moves up, but growth stagnates and interest rates fall. And then you should have the double whammy, the reversal of the interest rate component last year, where we capture the inflation piece through the capital and coupon increase, but we also then see the value of the bonds rise because interest rates are falling. So that's primarily our reason for holding those. We hold them as protection against that kind of environment. If we continue to see interest rates at a high level or moving higher, then index-linked gilts will struggle to offer us much in the way of return. But perhaps if we see interest rates moderate slightly and we see inflation stay at that 2 to 4% level, then they should provide us with a nice return, if not an extraordinary return over the next 5 to 10 years. So hopefully I've answered that question. We don't seem to have any other questions at the moment. So perhaps after 40 minutes, this is an opportune moment for me to hand back to Peter, if Peter is on hand and able to turn his video back on.
Thank you, James. Hopefully, can you hear me now?
Perfectly, yes.
Perfect, thank you. Well, can I just say thank you very much, James, for delivering such an excellent and very professional presentation. And thank you to all of you who have attended, taking the time out of your busy diaries to do so. It is I think it's listening to the Rothschild dynasty story. I think sadly the Rycroft Glenton dynasty as such is rather more short-lived, but give it time, maybe another 100 years, we might be able to match that, but only thanks to the generosity of our clients. So thank you again, all of you. And what I'd like to add is that the video has been recorded, so if you have an interest in sharing that or revisiting any of the slides, that we will be sending you an email with a link to it in due course, and it will also be placed on our website. If there's any questions that you have that you'd like to address to me or James in person by email afterwards, please just drop me a line. So I think to that end, I will wish you all an enjoyable rest of the day and a weekend when it comes. And back to the investment theme, hopefully we will shortly see an end to the current investment turmoil, and we look forward to some positive and high returns. So thank you very much. Thank you, James. Thank you, everyone. And good day.
Thank you, everyone. Have a good day.